Good morning, ladies and gentlemen. My name is Vuzane. I'm sure most of you are now familiar with who I am. Um, I just want to greet you this morning in such a chilly weather here in the Eastern Cape, and looking forward to go through what we're here to do today. Well, today we are looking at, excuse me, excuse me. We're looking on volume 7 the of our series being the Small Business Practice Common Language Guide, a guide that is meant to facilitate learning and professionalization of small businesses. In this particular series, we are looking at volume 7, that is the users of financial statements. But before I get to that, I just want to go through what we have done already and what information is already available at our disposal. Information that you can always access if you want to access. So, what we gonna do now is just to recap the things that we have done. So, in our information base, you'll find cycle 1.2 CPD. That cycle CPD was talking mainly about the introduction of the main presenter, that is myself, Vuzane, a chartered accountant of South Africa. And it also touched on who are we as an organization, and how to conduct us. It also looked on the change of logistics and the way forward in which we have done things. It also talked about frequently asked questions, a document that we regularly update based on the questions that we have received. And it also informed you that we now have a website that you can go through. All right. Then that was pretty much what was decided on in CPD 1.2. And of course, there are questions that one will need to go through for that. Then we went to cycle 1.3 CPD. In that cycle, we looked on one thing mostly, that is volume 0. Volume 0 was our course outline, which details the number of volumes that at SPSA we thought are sufficient and can lead small businesses into greater heights. So we're just going through that volume, trying to make sure that you understand what we're up to and what we wanted to do and what needs to be achieved. So that volume had 20 chapters in it, which is volume 1 to volume 20. And you were also given slides to that. That was pretty much what we talked about in volume 1.3. We went further to deal with 1.4. 1.4 was talking about two things mainly. It was talking about the SPPSA value chain, to say what is the structure of the problems that we need to solve and how do we want to solve those problems. And we also issued the version 1 of the combined assurance annexure, which we have issued to ensure that at least we've got one understanding of what must be reported, and of course the creativity of reporting that relies on the accountants and financial reporting clerks that are there. But at the gist of it, that document, the combined assurance annexure, is the document that outlines what exactly must be reported on the financial statements of a small business operator by a small business practitioner with the guidance of a financial reporting clerk and the chartered accountant that is working in that institution. So, but I think what was important in this part of the presentation was that we wanted to make it clear that for our purposes, the only person who signs and prepares financial statements, who signs financial statements, is a chartered accountant. There are many reasons for that, which we'll deal with them later on. And the purpose of the financial records clerk is purely to do bookkeeping, and we are that institution that is dealing with bookkeeping. All right, so we're not dealing with the financial statements for purposes of preparing them, but we are dealing with the financial statements for purposes of understanding what form of bookkeeping should be there to make it sufficient for the South African Revenue Service and for the Department of Labor and the CIPC to find comfort. So that volume one, that cycle 1.4 CPD was dealing with that, and that cycle goes into quite a detail of what must be done, and of course it's given, I think, 3 years, then another version of the combined assurance will be issued. Then we went to cycle 1.5 CPD. In that cycle 1.5, we're just taking a sample or an excerpt of the reporting process so that people understand what exactly must be done when a reporting process is done. All right, so that, because remember, we've got people that have been in business and we have people that have always been in business, and we've got people that have just joined business, so we thought that getting done with that cycle 1.5 CPD workflow will be important. Then we went to the financial statements and we issued our version of what we want our financial statements to look like, the financial statements of a small business that conforms with at least the suggestions of the small business practitioners of South Africa. With those financial statements, cycle CPD or cycle 1.6 CPD, what we're trying to issue a target of what must be achieved. So it's a benchmark to say, when you issue your financial statements this year, how far they are from what SPPSA would want to see. Then that was the end of cycle, that is phase one, that is cycle one CPD. Then we got now to phase two, phase two, getting further with the volume of with the financial statements. Now, in this cycle, that is volume 7, the users of financial statements, we are going to be busy with a few things that I think we should take out of the way. In this volume, we will be dealing with the shareholders or investors, which is chapter 1. Then in chapter 2, we will be dealing with lenders of borrowed capital, that is financiers, that is chapter 2. In chapter 3, we'll be dealing with suppliers of goods and services. And chapter 4, we'll be dealing with company employees and labor unions. And chapter 5, we'll be dealing with government and other regulators. And chapter 6, we'll be dealing with customers or buyers. Then chapter 7, we're going to be dealing with competitors of the company itself. And chapter 8, we will be dealing with members of the public, the community where the business trades or is situated. And lastly, chapter 9, we will be dealing with volume 9. It must interest you at this point to say, where are the auditors in this lineup of users of financial statements? Because auditors themselves, external auditors, will be needing financial statements to do audit. All right, so let us take that out of the way. What we've done was to exclude external auditors, although we touch them to a smaller degree in this volume, phase 2, volume 7. That information is included in volume 7, in volume 3, that is which is separate from what we need to do. So there is a volume that is still coming up, which we called about auditing and accounting in South Africa. All right, so we deal precisely in that volume about auditors. We do give a little bit of information as well following that on volume 14 and 15, that is the auditing of small businesses in South Africa. So that is the reason why you won't see information about auditors in this volume. It's precisely because there is enough information that is dealt with about external auditors in three volumes actually. That is volume 3, volume 14 and 15. All right. Now, once we are done with phase 2, that is getting further, we're now going to use the information that we have in phase 2 to develop phase 3, that is delving deeper. So in phase 3, we will be dealing with volume 5, that is the understanding of the entity and its environment, including its internal controls. Let us take it out of the way that there is a reason why you will say that the numbering is not it's not sequential. All right, it's because we are addressing important and cropping up aspects of what we see as immediate for to be addressed by our small businesses. All right, so these are the volumes that we thought should be given outright to those who are already in business, and to those who have just started, and to those who want to become a small business practitioners of South Africa. Then we are developing these volumes as we proceed. I think now we are in a better position to deal with now volume 7, that is the introduction to that volume. All right. Now, this part is the most interesting part. The users of financial statements, which is volume 7, which is part of the series Small Business Practice Common Language Guide, a guide that was uh, thought of as a target or as a benchmark that should be used for small businesses. All right. So I think we should take out a few things when we're dealing with this part of the information. Maybe let us immediately state that it is important that once a person has started, in other words, once a person has felt getting into a small business or has registered a business, this volume is very important. It is very important because at least it outlines some of the expectations and some of the understanding that a person must have, including his role in the reporting and bookkeeping process. So what we are doing here, we are trying to make bookkeeping simpler so that reporting is also understandable, and also to make it a point that at least there is understanding of what is happening in the accounting environment. All right. So accounting environment, in the sense that there are those who are preparing the information and making sure that the records are tight, that is the bookkeepers ourselves, and those who will be using that information for purposes of reporting them into the financial statements, that is the chartered accountants. Now, you would know that there are a number of users of financial statements, but we only selected 9 users of financial statements. These are the users of financial statements that we have seen predominantly playing an important role in the fail or success of small businesses. So the financial statements that we deal with are what we call generic financial statements. In other words, these are financial statements that are used by most users in the market. All right. So we call those generic financial statements. So it is in these financial statements which we talked about in CPT 1.6, in cycles 1.6 CPT. We're using those financial statements. So these financial statements are the financial statements in which all users get their financial information. So the needs of most of these users will be will be in those financial statements. The general users of financial statements, as we have seen in the previous teaching program, will include shareholders and investors, lenders, perhaps let me do this, lenders and borrowed capitals, suppliers of goods and services, company employees and labor unions, government and regulators, customers or buyers, competitors of the company itself, the members of the community, that is chapter 8, and directors of the company. Perhaps let us highlight the directors of the company. One would hope that we would start with the directors of the company as the first users of the financial statement. Even though the directors are placed at the end, they are an ultimate in the initial process of preparing financial statements. The reason the reason why we've placed it at the end wanted you to see how much work they need to consider when they are dealing with the financial statements and their importance in the complete value chain of the in the production of information. Remember, even though the directors are placed at the end of the chain, you will find them in any chapter between chapter 1 and chapter 9, and they've got a lot of information actually, in the sense that they are also involved in the bookkeeping of the company. They are the ones who are dealing with the financial records clerk. They are the ones who are dealing with the chartered accountants who's preparing the financial statements. They are the ones who are meeting with the chartered accountant and the FRC in the monthly progress reports. So they've got quite a wealth of information, and at least they understand what needs to be done between chapter 1 and chapter 9. Hence, we have put them there. So we should mention that we have to subdivide volume 7 into specific parts, because it's quite a big volume to deal with once and for all. So we are expecting that we're gonna deal with the introduction first and put it aside, and then deal with volume with chapter 2 and 3 following that. So the aim is to cover the material with utmost understanding and care, to ensure that there is an understandability of what needs to be achieved and what needs to be carried out, than to force you and rush you to finish the work. All right. And also, we want you to understand the role which these role players play in the small business environment. So as we continue with volume 7, it's important that you've got volume 7. It is also important that you have the financial statements with you that we're gonna be referring to as we proceed. All right. Now, if you look on the slides, so the slides are just a replication of the textbook, a textbook which is your responsibility now, not our responsibility. So you should get hold of the textbook. So there's nothing sensational in that slide. So what you will see in that slide is that you've got the authors. So the authors of this volume, it's Mr. Kholehla Fuzana. I'm sure you know who that person is by now. He was a chartered accountant and a master tax practitioner, an independent reviewer with SAICA, and a member of the Institute of Directors of South Africa. Next to me is Mrs. Mihle Machucha Fuzana, who's an AGA, South Africa. So here is how this information, how this book looks like when you get it. All right. So you will find that book on the ebooks. Okay, that book is available on the ebooks for those who want it. So from there you get to the critical reader. So the critical reader who was reading this book and making important suggestion is Dr. Jennifer Mirembe. who is a South African-based Gen AI strategist and urban futurist. She focuses mainly on fusing machine learning, spatial data analytics, and actuarial artificial intelligence. She is now offering a 360 Gen AI brand strategy packet, which includes editing books, delivering data-driven marketing prediction analysis, and designing international competitive company profiles with next level imaginary. So this book is published by Kunoka Properties Pty Ltd, and it was published in 2024. Now, getting to the background of the of volume 7, you will see that this book is not intended to cover specific users of financial statements, but is intended to cover specific needs of those users. All right. So it is divided into three. It is divided into interconnected knowledge and practical application and varying depth. So you will see that as we proceed after volume 5, we'll get into volume 6, where we'll be getting our hands dirty now, trying to sort out what exactly should be in your file in volume 6. So if we're looking on the practical application, you will see that the ultimate assumption is that the process of compiling financial statements is accurate. In other words, the what we're trying to do is to use accurate information to produce financial statements. So we're not guessing, we're not doing guesswork there. And this is exactly where volume 6 is talking about. So if you look on the brief of what the financial statements are, you will realize that most importantly, the shareholders and investors are interested in two things. They are interested in the business itself, so how much is the value of the business, and they are interested on how much returns do they get by investing in the business, and whether is there are there any prospects of long-term growth in the business. However, this is all different to what lenders and financiers want on the financial statements. So lenders would want to find out if the company will be able to pay the loans it is applying for, or the loans that are already in place, and what collateral that is there to secure the loan, what are mortgages that are there to secure fixed assets, and whether the company is financial liable or not. So what we've seen here with lenders is that when you ask for a loan, sometimes it depends on whether, in fact, some of the lenders will give you the loan to say, here is the 250,000, and some of the to buy whatever you want. Some of the lenders will buy what you want for you, all right, and give it to you, all right. So when they do that, they might want you to offer them a collateral or something like that. So what we've seen with lenders and financiers, they are normally for a long-term period, that is a period exceeding 12 months. Then you've got customers. The customers are the ones that are buying your product or service. And depending on the type of service or product that you want, customers would want to assess the reliability of your business, how long the business has been here, and what are the prospects of this business living longer than it has, and what quality of product or services do they produce this business. So that's how you get the customer trust. Then you've got what we call suppliers of the business, the people who are giving you things for your business to work. For instance, people who are supplying you with electricity, people who are supplying you with water, people who are supplying you with data for your computers to connect, people who are supplying you with computers, people who are supplying you with internet, people who are supplying you with machinery to print, people who are supplying you with ink, people who are supplying you with stationery, people who are supplying you with globes when the sink has blocked, when the storage is not going well, people who are fixing your carpets, they are all included here. So these ones are normally short-term suppliers, and they are included in the current portion of the liabilities. All right. So they are not exactly the same as the lenders, although they also lend, but their lending is normally for a short period. Then you've got government. Government and regulators, they monitor compliance with tax laws and tax obligations and tax regulation requirements. Then you've got employees. Employees are also company suppliers. Hence, when we do cash flow, you will see that when we're talking about cash paid to suppliers, we're also going to touch on employees. All right. So there is reporting that needs to happen also there on the employees. All right. Now, if we go to the shareholders, you will pick up that they've got two things that are important to them. I mean, a number of things that are important to them, but we have separated these into two. So, on the primary, we're looking on the business valuation methods, okay? To say shareholders are concerned about how their investments in business are valuated. There are a number of reasons for this actually, because you will remember that businesses are not the same, and because businesses are not the same, they don't operate in a single business sector. They, they operate in different sectors, and as a result of that, there are different valuation methods. So shareholders, when they value their business stakes, they want to ensure that a valuation is a right valuation is used there. All right. So we also deal in volume 0 about business valuations. So business valuations and techniques are in volume 17, where we show you how a business is valuated. And also at Small Business Practitioners of South Africa, we have an avenue where if you want your business to be evaluated, you communicate with us, and then we send a valuer who is gonna do that for you. All right. So it's a multifaceted stage up until a final valuation is done. All right. So they are also interested on the return of investment, which is also similar to the dividend prospects. So the shareholders are interested to know whether the current dividends that they are getting, they will still get it. And if they don't get it in the future, why is that the case? And also, whilst they are getting the returns, whilst they've been getting the returns and they are assured of future dividends prospects, they didn't stop hoping that the company will grow. All right. Whilst they do that, they are also hoping that the company is financially stable. It will continue to meet the shareholders' obligation and other stakeholder financial obligations. So, in most instances, when the shareholders look at the financial statements, they are looking at the income statement to say what are the profit margins, have the profits been growing or declining, or have the profits been varying, and what is the trend? In doing so, they might also look at they might look on revenue or sales. They might look at expenses at large. They might also look on certain expenses to say what is the behavior of certain expenses. And one of the expenses that they might be looking at is depreciation and impairment. So asset utilization efficiency to say they are interested to find out the assets that have been bought by the company, do they yield any positive returns or not? And then they are also interested to debt to equity ratio. The debt to equity ratio is the ratio that deals with the amount of liabilities, long-term liabilities the company has in relation to the equity. There is a big problem with that ratio with small businesses, because when these businesses start, they start really with very small capital, all right? And even when the capital is being injected into the company as the business continues, it is not properly recorded. All right. And most FIPs, they have included injection of equity into business as sales, which is a total dismiss. So we're encouraging you to understand the amount of loans you have and the amount of money from your pocket that you put into business. But as far as we have seen the financial statements of small business around South Africa, we've seen that that ratio is very bad, and that is where we want to stop it and try to find ways to control that. Then there's a cash flow. So maybe to talk a little about the debt to equity ratio as well, maybe will be to say why that ratio is also important to the shareholders. It's because it's about control. All right. So in your business, if the only money that you have is coming from the shareholders, it means shareholders are very happy. But if the money that is in the business is coming from loans and finances, it means the shareholders have got very little control in the business. The business is almost controlled by financiers, because most of the money is going to the financiers, and as a result, the decision making is all about financiers. So that is why that debt to equity ratio is important. It is manageable, but it is always nice to understand what information is there before you continue with your business. So control is very important. So cash flow sustainability, remember we've already talked about the returns here and the dividend prospects. So the shareholders are not only interested on the profits on the income statement, they are also interested on the cash flow on the cash flow statement. Why is that? Is the reason is simple, because the income statement includes both cash and non-cash items. Yet the cash flow includes only cash items, to say how much did we buy, how much did we receive, how much did we spend, and how much did we receive. It's a true picture of what is happening in the business. I must state that there are quite a number of problems with cash flows at a small business environment, because one, there is no proper bookkeeping. Two, there's a lot of cash that is sitting on the promise and the premises that is not reported in the bank statement, but is not also reported as petty cash. So once we deal with that, everything should go well soon. So then there's a going concern status, to say, will this business be a going concern in the future? I must separate the long-term growth prospects. So in the long-term growth prospects, there is no issue whether the business is a going concern or not. So we've already established that it will be a going concern, but we are not sure at which rate it will grow. The going concern status is whether or not this business will be there in the future. There are a number of things that we will look at when we're looking at going concern in each of our users of financial statements. So when we're looking at the shareholders, we will deal with the going concern and deal precisely what the shareholders are looking to see, what are their worries when they are looking at the going concern and what they take into account. We will deal with lenders of borrowed capitals when we're dealing with going concern, and deal precisely with what they want to see in the going concern of the business. The suppliers of goods and services will deal with that and see what are they looking at when they are looking at the going concern. The company employees and labor unions will also look at the going concern, but they will be looking at the going concern for different reasons. Government is interested in the going concern of the business, but also for different reasons as well. Customers are also interested on the going concern of the business. We've already touched to that a little bit. So they want to understand whether this supplier will be there for them in the future, and what quality of products will they be manufacturing. Competitors are very much interested on the going concern of the business because they want to understand if your business fails, they take up the market. Members of the public, for a number of reasons, they are also interested on the going concern of the business, and most importantly, are the directors of the company who also report about the going concern of the business. So you can see that the going concern is a very important aspect of what we're gonna be dealing with. So that part of the information we'll be dealing with when we're dealing with volume 18, that is the going concern test. All right, although we'll be dealing with the going concern in volume 7, we will be dealing again with it in volume 18. All right. So shareholders is at the top of the stakeholder hierarchy and are primarily interested in the financial well-being and prospects of the business. That is the ultimate, but that does not really mean that the other stakeholders are not interested in that. But because the shareholders start the business, they identify the need for the business to exist, so they are very much interested in the business making money. All right, so it is mandatory then that the financial statements are first given to the shareholders of the business. So the directors will prepare the financial statements, but the first person who needs to get the financial statements and who needs to get explanations of what happened to the financial statements are the shareholders of the business. All right. Now we get to the suppliers. We get to the lenders. So the perhaps let me just go back and clarify a few things here in the shareholders. So if you start a company and say, this is my company, I've got an understanding of how this company should work, and you start the company, you become, so if you've got a vet and the intellectual property of what the company must do, you become a shareholder of the business, and you invest initial capital to the business, whether it's cash or through skills or through other things. But the effort that you put into the business for it to get started, you become the shareholder for that, especially when you are not employed by someone else to do that. Then you become a shareholder for that business. But it doesn't only end there. Shareholders are also people who look into businesses, look on how the business perform, and they decide to buy a stake in that company. So if you buy a stake in the company, you also become a shareholder because you have bought shares in the company. So the mistake that we have seen in small businesses is people think that by just opening a company and registering with the CIPC, you automatically become a shareholder. You're not. Until you have proven that you have bought a stake from the company, then a stake that is uh, confirmed by a certificate of ownership that that company is yours. It doesn't have to be cash. You can count the number of hours you spent trying to make the company right, because remember, you can start a company with a loan. It doesn't mean you are no longer a shareholder of the company, but the effort, the time, the skill, the vets, the intellectual capacity that you have for the business to succeed makes you a shareholder. Now, shareholders are entitled to dividends, okay? Whilst they are part of the company, they are entitled to dividends of the company. So the company will need to pay dividends to the shareholders. Now, they can also sell the business, all right, to someone else, all right. So you can never have a business that you did not buy. You can never have a business that you never imagined it happening. Only because you are in it, you think the business is yours. So let us correct that part of the equation. Prove that you have the certificate that the business is yours, and you've got proof one way or another that you have acquired the shares of the business, then you are a shareholder of the business. Then we're going to deal with that to say what then does it mean to be a shareholder. But without you getting these steps out of the way, it's not possible that you can call yourself a shareholder. Well, you've got lenders. Now, one of the things that you're going to do, you will soon realize that you need more money. You as a shareholder, you don't want to use your own money, or you want to use your money plus money that you borrowed from someone else to do a specific thing for your business. Whether you're going to buy furniture, whether you're going to buy inventory, whether you're going to buy a piece of land, something like that, or whether you're going to buy a machinery, you might decide that you're not going to use your own money. You're just going to go and borrow it. Take, for instance, someone who has got a car. That person can say, okay, I've got a car that is sitting outside. The car is good, it's performing well, there are no issues with the car. But I've got a funeral that is in market in KwaZulu Natal, in rural areas there. So instead of buying a car, or instead of using my own car, let me just go and borrow a car from one of the car rental agencies. All right. So it's similar if here you might have money as a shareholder, but looking at the value of what needs to be done, you decide that no, I don't want to use my own money. I want to do this project with a money that I have borrowed from the bank. Well, that is one part of it. The second part of it is that you might want to add, you have a ratio of what is your money and the money that you would have borrowed from someone else. All right. So once you borrow from someone else for a longer period, you will now attract what we call the lenders and financiers into your business. All right. So when a financier is giving you money, let's say they are giving you 1 million rand. So that 1 million rand is gonna come up with an interest. We understand the regulations of the National Credit Act in this aspect. But what is important is that we should remember that not everyone will get a bank approval. All right. So what we have also seen is that people will also go to their friends, to people known to get money, and they will agree on the terms of interest that those people will want in return. All right. So once you get that money and it's deposited into your account, first you must understand whether it's a secured or it's an unsecured lending. Remember when we talked about the suppliers and the lenders, we said there is collateral. Okay, is there any collateral from what you are given? In other words, if you are given 1 million, can you say, okay, in the event I'm unable to pay my 1 million in the case of a fixed asset, can you take my Jeep that is sitting outside? All right, so that we call that a collateral. If you're buying a house, normally a house becomes a mortgage for the loan. In other words, if you can't pay the house, the financier is going to come and take the loan. So, I mean, it's going to come and take the house. So what we've seen is that the term secured and unsecured is just a term, but from what I've just explained, we can immediately see what is a secured loan. But also we want to mention that there is nothing called unsecured lending. So what financiers will do, they will say, okay, you don't have something to give us for us to hold in case you don't pay us. You say no, I've got nothing. So what they will do, they will give you a high interest rate. Okay, so they use the interest rate as to secure the loan itself, so that by the time you default, at least they've collected the bigger part of the loan from you. Remember, the loan that you pay to the bank or any financier is the payment of installment. And in that installment, there are two components there. what we call a capital and what we call an interest. So these unsecured lending, they call themselves unsecured lending for just the benefit of the word, but the way they charge interest, it is the interest itself that secures the loan. So let us get that out of the way. So don't be too excited when you get a loan and it's called unsecured loan. Just look at your interest rate and see how much that interest rate would have been had the loan was secured. So those two will be totally different. So on the financial statements, when you make an application, you are facing scrutiny from various multiple decision makers. These people are looking at your financial statements to examine the personal credit history and business viability before approval. I want to talk a little bit, which we're gonna deal with it when we're dealing with that chapter two, the credit worthiness of the director. So what we've seen is that if you borrow a loan from a bank or any financial statement or any financial institution rather, what these financial institutions will do, they will first decide how many directors are in the business registration document, what we call the CK. So if there's two or three people there, two or three people there, they will also look on the personal credit history of each of those people. So they give a loan based also on the habitual credit history of the directors. So the credit history, personal credit history that they do, it's in addition of what is being considered by these financial institutions when they are examining the financial statements for approving the loan. So this is not the personal credit history is not in the financial statements, but it's a document that you will need to produce separately, whether in a form of personal balance sheet, whether in a form of personal expenses. So that is the personal credit history, and they will also look your name on the credit bureau as well to find out how you have been doing things there. All right. So, and also look on the financial statements to predict if the business itself is viable. What is the business doing? Where is the business situated? Who are his or the business customers? What is the potential or the buying ability of the creditors? Where is the business situated? What type of product is being sold? Is it a needy product or is it a luxury product? What is the age of your customers and so forth. Okay, are you selling? Is your business focusing on children? Is your business focusing on elderly, or is your business for everyone? All right, so things like that, they will be very, very important. So this is also important when there is no separation between shareholders and the directors. Remember, if we talk about shareholders here, there are two types of shareholders. We've already mentioned that you start a business with your own capital, or you don't start your own business. You just look around and say, I like this business. Let me talk to these guys. Guys, what are you doing there? They say, we're selling fat cooks in the ordinary streets of the town. And I'll say, wow, there's a lot of money on fat cooks. Guys, can I be a shareholder? I'm gonna give you 10,000 rand. All right. But for every 1 rand that you're gonna make, I'm gonna need 25 cents. Okay, so you become a shareholder like that. But you're not involved in the baking of fat cooks. You are not involved on how many fat cooks were sold. You are not involved, say, how did the electricity affect the production of fat cooks, how many fat cooks were robbed, how many fat cooks were overly salted, and all those things. You're not involved with that. So you become a pure shareholder. But there is also what we call a dual shareholder. A dual shareholder is the person who starts the business with his imagination, with his intellectual capacity, and also get involved in the production of what needs to be sold. And that person becomes a shareholder and the director. So wanted to talk about that and take it out of the way. So in that instance now, when the business is applying for a loan, So the personal credit worthiness or personal credit history is for two people. Is for the director as the person who's listed on the financial statements, and as the shareholder, the person who started. So if you are one and the same person, you are evaluated twice. All right. So I thought we should take that out of the way. So with secured and unsecured lending, we should understand that there is nothing called unsecured lending. Uh, but uh, uh, yeah, there's nothing called an unsecured lending. Even if your friend gives you 10,000 rand and say um, uh, uh, you will bring it back 10,000 rand at the end of the year, no worries, not we'll be friends forever. The minute you don't get that, the minute your friend does not get that 10,000 rand at the end of the year, your friendship gets sour, and the effects of that sourness is the secured part of the loan. All right. Now there are also sureties and guarantees that are part of this. These are documents and people that are signed. That these A surety is a person, a guarantor is also a person, but there are also documents that confirms these people. So sometimes what will happen is that I'll go and take a loan, then the bank will say, do you have a surety? I say, for the business. I say, I'm a surety for the business. In other words, if the business fail if the business fail to, to pay, to meet its obligations, I'll start meeting the business obligations. That is myself. But a guarantee is someone else, all right, who guarantees that in the case something goes wrong, that person becomes liable for all the costs. Okay. Then we've got personal financial health. Okay. So here we normally use a personal balance sheet as part of the lending process documents. So you will submit the financial statements and you will also submit the personal balance sheet. You might also want to submit your monthly budget as well. So those are the documents that are backing up the financial statements for your business to get approval. All right. So maybe it is important that we should mention that here that as the owner of the business, it is important that you manage your personal expenses. You don't spend extravagantly, and also you manage your personal balance sheet. In other words, you write down everything that you own and the correct values for that. Okay, try to bring down your expenses, try to increase your sources of income, and try to record your belongings, that is your assets. Try to minimize on your debts and try to get correct values for your assets, so that your assets are not understated. You always bought good valued assets there. All right. Then you get to the suppliers of goods and services as the users of financial statements. So uh, they've got also a lineup of things that they look to find when you apply. Let us say, for instance, you have started your business. Now you want a space to rent. That becomes a supplier. Your landlord becomes your supplier. So your landlord can look and say, okay, I've got this tenant here who's making an application to occupy one of my rooms or one of my buildings. Do you have financial statements? You say yes. So in the financial statements, they will look at the age of the business, how long you've been trading, how your revenues have been, were you reporting profits, and if you were reporting profits, what were your profit margins? Uh, so the difference between revenue and expenses is going to give you our profit. What are the biggest expense? How have you been managing your expenses? Are you paying your expenses on time? What type of expenses do you have, and why you are having these expenses? Then they look at the balance sheet to say, okay, this guy wants to occupy my space. How much does he have? What does he have? Okay, what are the assets? Oh, this guy has got these assets, he has got these liabilities. The assets exceeds liabilities. Okay, this is a good business. Okay, the liabilities are more than the assets. This guy is gonna fail. I'm gonna be frustrated to have this guy as a tenant. and all those things, because they are in a serious equitable position. All right. So they won't be able to meet my obligations. So if they want a space of 10,000 rand in one of my buildings, and their liabilities are this high, their assets are this low, they are reporting losses, they have got declining patterns in revenue and increasing patterns in expenses. No, I cannot give these guys a space. So that's what suppliers will do. They say, okay, I've looked at the assets, and in the current asset, I want to look at cash. How much cash is there? Is there any amount that is sitting on the premises in the form of cash flow? Yes, is that. Has the cash flow been positive, or the business has been operating on an overdraft? No, the business has been operating on a positive cash flow for over some time now. So, okay, what is the cash flow per month? Will that cash flow per month meet my monthly rental? Yes, it will. Then you get it. In some instances, some businesses may want payment references to say, have you ever been a customer to someone else on credit before I give you credit? Because they cannot clearly certain from the information that you've provided if you've got any liabilities, or perhaps that information is there, but they just want to complete the process and to make sure that they've done everything they could before they grant you credit. Okay, so they say, can you please send us 5 payment reference letters from your previous suppliers? Then people people will look around and asking for these payment reference letters, even to people who were never creditors of that company before. Okay, so there is normally a rigorous process that is done by suppliers. They don't only look on the revenue trends, they also look on the expense of line items for each expense to say, is this expense growing up or declining, and what are the reasons for that? For how many times the business has been reporting profit instead of, the business has been reporting losses instead of profit, and what are the reasons for making losses, and all those things. So liabilities, who is actually being owed? Uh, Sometimes when people look on who is being owed, they are primarily looking on the strength of the creditor. For instance, if you are owing SARS, chances of you getting approved somewhere else are very, very low, because SARS have got much, much more power than other creditors. Okay, so people rank their creditors and say, what type of creditors do you want to compete with? In other words, if you rank your creditors and you want and there's a time for you to pay out the creditors, which creditors will pay first between the landlord and SARS? So SARS will pay first, and other creditors will be paid loss. So suppliers are very interested to find out what type of creditors do you have there. And also they are looking at the liabilities and assets for the debt equity ratio. Remember, we talked about the debt equity ratio when we talked on with shareholders, about shareholders. You saw that when we talked about debt to equity ratio, when we're talking about shareholders, we specifically listed few indicators on why the shareholders are interested in the debt equity ratio. But here, the debt equity ratio is for something else. It's purely to make sure that, will this person be able to give me my money at the right time and at the right amount? All right. Because if you occupying someone's business and the rental amount is 10,000 rand, and then the lessor is interested in finding out whether you will be able to pay the 10,000 rand on the agreed date, and you will be paying the whole 10,000 rand. So you won't be paying 2,000 rand on the 15th. So if the agreed date is the 4th of every month, you won't be paying, you need to pay the 10,000 rand between any date and the 4th. So you will not be paying 2,000 rand on the 15th or the 17th of the month. So they are very interested on issues like those ones. All right. Then you've got the cash flow statement. So they are also interested to say, no matter how small your cash flow balance is, but what is going on there? Is it on a negative? If it's not in the negative, if it's in the negative, is it continuously getting to positive? Or if it is positive, is it continuously going up, not declining? All right. And what is eating most of your cash? So they are mostly interested in doing that. And of course, payment references will also indicate what did you buy on credit, from where did you buy on credit, when did you buy on credit, how have you been paying, what is this asset helping you, and all those things. So those are the things that you might want to get. And also on the balance sheet, the creditors might want to also look to see what is the working capital ratio, that is what is sitting on your current assets and what is sitting on your current liabilities, all right, so as to determine if you are able to meet the short-term obligations. So in the cash flow statements, the bigger part of interest for the suppliers of goods and services is in the cash flow for generating cash flow from operating activities there. So suppliers are gatekeepers to business survival, providing essential resources that enable operations. That is true because you don't always have money to beef up your business. So it is important that you build trust with suppliers through transparent financial reporting. I think what we're trying to do at SPPSA, we don't want only to do transparent financial reporting. We also want to encourage small businesses to get into a spirit of reporting accurate financial statements so that they are able to get favorable payment terms there. All right. Then we get to employees of the business. Remember, when we talk of employees, we mentioned that employees are also creditors of the business because they are offering a service for which their service is paid for at the end of the month. So they are concerned with a number of things to say, will this business be there to secure my job? Okay, how is the business stable? For instance, now in South Africa, we've received news that most companies are closing down. Some of the companies are going back to Europe and all those things. And I've got an uncle now who has come back from Joburg. Their company made a retrenchment notice that it's no longer gonna continuing operations. It's trading for the last time in the year 2025. So they've been started giving them packages, and the business is being scraped off to say we're no longer doing this, we're selling these assets, and so forth. So when we're looking on the financial statements, the employees would want to see if their job are still confirmed and the business is stable and it will continue to go as a going concern. Okay. So they may also look at the financial statements to find out if at least they are remunerated well, to say, yo, with these profits and with these cash flows, why am I getting paid so little for the work that I've done or I'm doing in this company? Okay, are there any growth opportunities in the business? Can I go into higher heights as an employee, and will I be able to be remunerated as I go through the ranks? Working conditions, are the conducive, are the working conditions conducive, and what are the safety regulations affecting the business? Am I safe in this business? And could it mean that we are working under these conditions because the company doesn't have money or the company doesn't care? So the financial statements will address so most of those things. Financial health of the company is gonna talk about the profits in the balance. I mean, in the income statements, it's gonna talk about the sales in the income statement, the expenses in the company in the income statement. All right. So the employees will look into financial statements as indicators of their future with the company and their potential advancement within the company. So these might not know what is. So it is possible in the small business environment that you might not know, you might not have seen the financial statements of the company because most of the businesses are privately owned, and they've got a small staff turnover, and as a result, it's not usual that we share our financial statements with our employees, all right, for a number of reasons. Okay. So, but in some instances, but in very few instances, it's possible to see the financial statements of the business. But in the small business environment, it's always not easy to determine whether the financial statements are a true reflection of the business itself, because there is no process like SPPSA which encourages and teaches people to get into accurate financial statements and make it a habit to get into financial statements. You'll find that in the small business, there are more than 3, 4 sets of financial statements for 1 year. And when the owner wants to submit for a bank approval, they will submit a different set of financial statements. When they submit to SARS, they submit a different set of financial statements. When they submit for CITB grading, they submit a different set of financial statements, which is similar to one they submitted at the bank. So you get those instances, and that's what we want to stop, because those processes don't help our businesses to grow, and also they don't help our accountants to do the right thing there. All right. So, of course, unions are interested in the company's ability to increase wages. They are also interested on the working conditions. They are also interested on collective bargain leveraging, which is not normally there for small businesses. It's not something that is there. Profit sharing potential, to say, are there any shares that are given to the small to the employees? Of course, that you won't find it in a small business environment. And also, when the company is closing down, the employees would want to see the financial statements to validate evidence that the company is not making more money, and financial statements can be used for long-term viability. I'm sure this term you have seen it more frequently now. We talked about long-term viability and going concern when we talked about shareholders. We talked about long-term viability and growth when we talked about financiers. When we looked at the suppliers, we also looked on the long-term viability, because everybody is interested to find out whether the business will be there in the future to complete the obligations it has with them. All right. So the increase in wages between the employer and the employee has always been the biggest challenge to get out of the way, because the employees want more of salary, and the employer do not want to give a lot more of salaries for a number of reasons. One, we also have shareholders that we need to give dividends to. Three, we still have tax to pay, so we don't want to give more money to the employees and we don't have tax to pay. And three, if you give more money to employees, there are also things like COIDA. It means you are paying more on COIDA. It means you are paying more on pay as you earn. It means you're paying more on skills development as well. So employees would want to minimize that type of expenses as much as possible, and also to say, if I'm paying employees this much, this company won't be there in 10 years time. But if I pay my employees now this much, this company will be there in 30 years' time. So these are the things that are considered when we are looking on the financial statements, particularly when we're looking on issues pertaining to the employees of the business. And also on the longevity, you will find that some employees and employers are looking on the retirement stage to say, have I gathered enough money for my retirement, and will I be able to honor my retirement obligation as an employer when that time comes. But what we see at small businesses is that there isn't really worry about long-term retirement, because in most instances even the employees at small businesses do not stay there for longer for a number of reasons. The businesses are small, the treatments are not good, and employees are getting offered other cool conditions elsewhere, and so forth. So sometimes it's to think that somebody might be in the business for until retirement. It's not always possible. I've seen it though with some of my clients. When we started in 2015, you find that yeah, there was a secretary to this company or a reception, and that person is still there, and is enjoying, is doing well. But will that person be there up until retirement? We don't know. So it's not possible to think that maybe they will always be there up until retirement. So retirement is not always the case with small businesses. Now we get into government. Government is a regulator. So here are the things that we'll be talking about with government and other regulators. If you remember our value chain, we said we wanted to address three government entities, that is the South African Revenue Service, the Department of Labor, and the CIPC. All right, so we need to package our information such that it's able to meet SARS requirements, because SARS is going to use our information to examine financial statements, and when they do that, they want to verify if we comply with tax, and to see if they can raise any liabilities for us, and if there's an agreement between what we have reported to them and how they see our business, to deal with and get us into potential audits. So on the compliance side with SARS, bookkeeping should help us with registration, proper registration, to say we are registering tax types on time, and when we do that, we close our returns on time, and we close our returns accurately. So that's what we do. So there are instances where we submit on time, but we submit inaccurately, then we attract penalties and interest. And sometimes we submit but we don't have money to pay, then our debt is increasing. And also the debt that is there is not service. We're not making on time the payment arrangements with SARS, and to do that. So there are a number of tax types that we will see as we continue, especially in volume 6. So income tax for juristic persons will be closing a return called ITR 14. So in ITR 14, there is a return that is closed at the year end of the business, but during the year, the business will be required to close what we call provisional tax and what we call employees tax, especially for those businesses that have employees that qualify for pay as you earn. Then if your business is also registered for value added tax, will also be closing value added tax. So there must be a process at small businesses that we design to make sure at least that the information that we are closing on behalf of the company first is accurate, is known, and is correct. Okay, and we help these small businesses to make suitable tax arrangements there. The sad part about tax arrangements is that once you default, SARS just goes out of that arrangement, and it's difficult to bring SARS back into that arrangement. So it's always important to see when your business is not going to do well, go and make an adjustment to say this is what I'm going to be able to pay going forward, than to just let it fail. Well, when you are making an arrangement with SARS, there are a number of other documents that must be available before an arrangement can be approved by SARS. So what we've seen is that most businesses are not really prepared, don't have those documents handy, these are documents that always need to be studied afresh every time there is this type of arrangement with SARS. So what we're trying to do with small business practitioners of South Africa is to make sure that we are always up to date. We have documents that are able to meet our purposes at all times. Okay. So we've got Department of Labor. So Department of Labor has got interest into a number of line items as well in our income statement. So when we're dealing with Department of Labor, we should first identify if the owner of the business is getting what we call the director's remuneration, and we need to get the salaries of the employees. Sometimes the directors of the business are also employees of other businesses. For instance, you'll find that the person who runs Kunoka is also an employee, maybe of the Department of Health. All right, because is a medical doctor, perhaps in one of the hospitals. I'm making an example. So he's a medical doctor with the Department of Health, but is also running Kunoka general practitioners. All right. So there are directors of narration for the directors. Then we've got salaries for the ordinary staff. Then we've got UIF. Okay, so we need to be careful on how we deal with UIF, because UIF is in two parts. It's the UIF that we deduct from the employee, and there's a UIF that the employer pays in addition to what has been deducted to the employee. And depending on how much it is, the UIF is not always calculated at 1%, but whatever it is, it must always be 2% between the employee and the employer. And we must also check whether the business does not qualify for SDL, and also we must have a formula to calculate COIDA there as well. All right. So these are the issues. So COIDA can be quite a complicated issue because it's not understood. But if we understand that COIDA is calculated monthly on the employees that were there during each month, it should not be easier. But what we have picked up is that it's always difficult to understand the formula the Department of Labor uses in calculating the COIDA there. So it's normally giving us problems with our clients. So it's always an accrual because COIDA is paid between May or in May of the following year. So if your year ends on the 28th of February 2025, so the COIDA that you have accumulated between 1 April and May, 1 June and May, you will pay it during May. All right. There are also issues with the Department of Labor, like the national wage, and the affordability there remains an utmost challenge, and it's a complex issue for small businesses because Department of Labor will come to your premises and ask for the payroll of the employees you supply to them with their employees' details, and they say to you, no, you are underpaying this person. You should be paying this person 5,500. And you say, no, I made an advert here because I can only afford 3,500. And they say, no, we're going to issue a compliance certificate for you. Then you discuss this with the employee to say, look, I cannot afford 5.5 because I need that 2,000 rand to pay for electricity. So in that 5.5, I've got two suppliers. I've got you and electricity. So if I'm paying you 5.5, so there are a number of those discussions. Then sometimes we see some of the employees laying off the employers laying off some of the employees because of those issues there. So then there's CIPC. As what is important at CIPC is the annual return that is closed at the anniversary of the business itself. So it is important to understand when was this business started, and then it means that before a year ends, again, every year ends, we need to close a Section 33 annual return. So what we should also remember here is that the annual return is based on on the amount that you have made, not necessarily on the financial statements. So I've seen people saying, no, I can't produce or calculate an annual return because I don't have financial statements. So that is wrong. So you just have to have SMRS, the summarized monthly revenue schedule, that is going to help you with that one. So we're going to show you what is that. So once you are done with that, you would have dealt with CIPC. So annual returns for CIPC have always been the biggest issue because it is not always accounted for accurately. There was an instance in one of the years where government, the newspapers showed a number of businesses who did not, big businesses who did not complete accurate annual returns with the CIPC. So this becomes an important issue for small businesses. I think the issue here is about training people and making them understand what is right. So by the time you do what is wrong, at least you know that this is what is right. Because the argument between the accountants and business owners is that, no, I'm not an accountant. The accountant is doing the information for me and is submitting it from. So I'm not aware on what accounting is and how it works. On the other side, the accountant says, no, you said I must do this. You instructed me that I must do this. So whatever the case is, we put want to put out benchmark targets to say whatever you guys are deciding on. So nobody now is going to come back and say, I don't know. We are giving you what must be known, and so that you know what must be done. All right. Because there's this wrestling between accountants and business owners, and we understand this where it comes from, because also for accountants it's difficult to fight with your client, because that is someone who is employing you, is paying your rent, is paying your car, is paying your school fees, so you try by all means to meet the expectations of that person. But now what we're trying to do is that whatever arrangement is between the two of you, at least the two of you must understand what is right. Okay. So this category of users of financial statements okay, perhaps before I get to this part, I just want to go up a little bit and talk about shareholders. So shareholders are entitled to financial statements because they're the owners of the business. So once the financial statements have been done, they must be given to the shareholders of the company so that they can debate, deliberate, and understand the financial statements. So lenders of financial statements are not entitled to financial statements, but they will get financial statements because of you made an application to get finance from them. Okay, so giving them financial statements is voluntary, so it's not their obligation. However, if SARS is your lender, in other words, you owe SARS becomes a regulator and they will get the financial statements. Also, the suppliers of goods and services are not entitled to your financial statements. Only you can give them your financial statements because you want something from them in return. Employees, we've already mentioned to the employees that rarely they get financial information of the business because these businesses are small. The small business practitioners have got lots of secret about their financial statements. They don't want to be seen how bad they are doing and all those things. So, but in some instances, we have seen some of these small businesses giving financial statements to their employees. Government, SARS will always get the financial statements. Department of Labor will always get financial statements, especially when there is a decrease on the amount you are paying between the 2 years. They will want financial statements. They even make it worse and say they want audited financial statements. CIPC, they don't really want financial statements. All they want is for you to file your annual return. They don't even ask for a proof for those annual returns to say is the information that is used to submit those financial statements accurate or not. Then we get to customers. Customers also are not privy to the financial statements of the business, especially at a small business environment. But when they do, there are information that they would want to know about the business itself. That is, they would want to do reliability assessments of the business. Can you see the going concern again is coming here for the buyers now? They will also want to find out quality indicators, quality product indicators, and response capacity. So, with the reliability assessments, they want to understand whether your businesses, your goods or services are cheap, but good of a good quality. They want to see how accessible your products are. Where are you? How far are you? How fast can you deliver? Do you have enough resources to deliver at the time they want? What are you known of? Are you known of poor quality or good services, reliable and long staying goods and services? Are you about to close? What is making you to close? Where are you going? Are you relocating? Are you closing down altogether? Are there any substitutes now that your business is going away? So that is reliability assessment, or even for them to start looking for other suppliers if they find that you are not gonna be here for some time. Then there is going concern. Also, what we've seen is that there are customers who will pay prepaid expenses. For instance, if you are an accounting firm, you charge your clients on a monthly basis. Let's say this guy is paying 3,000 Rand a month for accounting services. Then this guy just decided, say, I'm not gonna pay this 3,000 Rand a month. Let me just pay 300,000 Rand to this guy, all right? And I know that I'm done with accounting service. So that customer will be interested to know, with the 300,000 Rand of prepaid expenses I've paid to your business, will you be there when I need you? Will you be there in the future? What if I pay 300,000 Rand today and the next few months your business closed down? All right. So reliability assessment and going concern, they go together in that part. Okay. So with the going concern, they need evidence of operations. Will you be there when they need you again? And not only for sole proprietors or partnership, also for touristic persons, because if I'm not doing well, chances are, even though the touristic person have got perpetual continuity, it might follow me and die as well. All right. And there are some of the customers are looking for cheap but good quality products, but others are looking only for quality products. Okay, so they are looking for suppliers who will supply that. So customers want to find out from the financial statements if you are able to do that. There are also response capacity problems. So when it's not only about delivery of the product, also when an inquiry is made, when a complaint has been made, the suppliers are interested to find out the speed in which you respond to them and how the quality of the responses that are given to their complaints as well. So financial statements can give that information to say how many complaints we've received, how many complaints we've dealt with. This is the speed in which we have dealt with, and then all those things. And some of the customers can attest to that. So customers judge businesses not only on products but on premises, on promises. Will you be there when I need you? And will you be there with the right service that I want? So that's all the customers want. And when we deal with that, we see that in fact, when we deal with that, we'll see that in fact customers are really much attached to customers that respond, to businesses that respond in that type of manner. Competitors look for a number of things, but at a strategic level, because remember, these are the people that are sharing the market share with you. So most of the time, they'll spend time doing market analysis of their competitors. There's a group of people that is normally employed to do that. But at a small business environment, you won't really find that type of a situation where you spend time, because the financial statements of small businesses are seldomly available. So So what they will do, competitors will scrutinize financial statements to benchmark performance to say how is your income statement look like compared to theirs. What are your strong points as a competitor? What are their strong points as your competitor? What are the weaknesses as a competitor to them, and what their weaknesses as a competitor to you? And they use this to improve themselves. When they do that, they look on the income statement, they look on the balance sheet, and they look on the cash reserves. So the issue is always about the market share. So when you look on the market share, you'll realize that some of the competitors don't want you to die. They just want you to be there because they won't be able to service the whole market if you die. But there are competitors who want you to die because they want the whole market for themselves, which is also dangerous because sometimes it's always nice to know that if the customer does not find you, someone else will be able to help the customer. So they are more interested to find out on the revenue and market share to say where are our customers, how far are we from our competitors, where is our customer, how far is our customer to us, what is the price, what is making up this price. Pricing has been a biggest problem in the market, all right, especially unregulated prices. And we've seen customers taking prices, unregulated prices, and comparing prices with other people and trying to make a big drama out of that. So we should be careful when we're talking about prices. So what type of goods you are selling, your competitors will be, how are you selling them? Are you selling them on a mass production? Are you selling them on a batch production system? And what tools of trade are you using to that? They are also looking on why the customers are buying from you and not them. What do you do? I remember a story that I got from our professor when I was studying my CTA at the University of Fort Hare. He told me that sometimes you buy a product from your competitor and dismantle it. But when you dismantle it, you are trying to find out what is this product made up of compared to my product. Why is it that these people are buying this product and they are not buying my product? Let us take bread, for instance. A competitor may go and buy your bread and eat it and find out why people enjoy your bread so much. Your bread is fluffy, is buttered, is fresh, smells nice, packed clean on a transparent plastic. Plastic is the packaging is properly labeled and all those things. So customers do all those things because they also want to be part of the market share. What type of expenses do you have on the cash reserves? How do you offer your product to your customers, and what customers do you have? All right, are you selling to a specific age group? Are you selling to children? Let us take Pampers for instance. Pampers is not selling to university students unless those university students have got babies, but their target market are babies. So they will look on issues look like those ones. On the cash reserves, they want to find out where is your financial muscle, what is making you strong, where are you getting your money, is it worth it to compete with you or just to leave you, what type of information they can get from you for them to learn. I remember when I was in Cape Town the other day, we got into this shop and I said, this shop, it has got an outlet. And this guy said, yeah, we've got outlets here in Cape Town for this shop. And he told us that, look, this shop has been making losses for the past 8 years, no profits at all. But what we then talked about was that they've got a good financial backup from their shareholders. Their shareholders are wealthy and filthy rich, so they're not worried about temporary profits. But as they penetrate the market, as they knock to the market, they are willing to do that. So competitors might be interested to say who is finding you, why are they finding you, why are they persistent in finding you, whilst you are making those losses and so forth. So this is information that competitors will be interested. It is possible that within the small business environment, competitors may not access the financial information of the business, because that information is rarely available to the to the outsiders there. Right? Then you've got the members of the community. So what we pick up from the members of the community on the side of the financial statements is that they also not privy to the financial statements, but they can get the financial statements if they find that you are not doing your business well in a good sense of it, by applying to the court. Okay, so they are normally interested in three blocks: the environmental impact, the employment creation, and community investment. Okay, so on the first block, that is the environmental impact, they are interested mainly on how the business affects the environment in which the community resides, the health side of the business, to say how does it impact them, especially those with children and those who are disabled. All right. So how is your production affect or puts pressure on transport? Remember, when people are sick, they need transport to go to access medical facilities. And even though people can access medical facilities, but the more people get into medical avenues, the more pressure and the more strain the medical avenues will get. And as a result, not everybody might get help. So they want to understand how is your business responding to that. So let us take, for instance, companies that are operating in rural areas where it's even difficult to go to town in some instances, or where there's only one bus that is going to town that leaves in the morning and comes back in the afternoon. So where, for instance, when that bus leaves you, or when you miss that bus, chances of you going to town are rare. So you need to wait up until tomorrow for you to go to town. So environmental impact also talks to that, to say, with this company, what will happen to me if I get sick during the day? Will I be able to go to town and access medical facilities? So they are interested in things like those ones. So there is also employment creation, to say, how is the company employing people who are local compared to others? This has been a very big story in South Africa. I remember there was a huge noise on this with Sasol, where residents at Sasolburg were saying that Sasol is not employing people around Sasolburg. And Sasol responded and say, we are employing people from here, but with the skills they have. So when they don't have those skills, we go somewhere else. So I think it was a justification now. So the community wants justification when they see more foreign people. So the issue of foreign from this story I've mentioned would mean that there are two instances where foreign can be defined. So if I'm in the Eastern Cape, it means that a business that is here in the Eastern Cape that is employing someone from Limpopo is employing a foreigner. So it's a local foreigner. But it is possible to further explain a foreigner. So the business that is here in the Eastern Cape and employing someone from Japan, so that person is also a foreigner. So we just have to understand what type of a foreigner this is. All right. Then we get to community investment. So financial statements reveal corporate social responsibility initiatives and community support programs. So the community would want to know, now that the company exists within our domain, what type of social responsibilities is the company helping us? So I've seen some of the companies doing a lot of local and social projects, for instance, donating school shoes, donating Colgate and toothbrush, donating socks, donating jerseys at winter, donating school uniform for those who don't have, donating carrier bags, donating school lunch boxes, and all those things. So those are what the companies are choosing to do. Some of them are donating computers, some others are just donating computer labs. So these are the categories of community investment the companies will always do. So we have already addressed the issue that community members themselves don't always have, uh, cannot mandate the financial statements of the business. But if there is something wrong, the court might grant that the entity provide the financial statements of of that business to the community. So those are the issues that perhaps one would want to look at when we're dealing with community members. I'm sure now you have got no doubts in your mind on why you have put the directors and management at this stage. You have got no doubt on the level of reporting the directors have to do on the financial statements, because the directors are the ones who have to understand all these type of stakeholders and their needs. So you will understand why the directors are so important in the company. First, we should, when we talked about the shareholders, we should have mentioned to you that it is possible that the shareholder is not the director of the company, or it is possible that the shareholder is both the shareholder and the director of the company. All right. So with that information, whatever the case may be, the role of the directors as appointed by the shareholders, or as they work as the directors and shareholders of the company, their biggest role is to maximize shareholders' wealth. So there should be no issues on the steps the directors are taking in maximizing the shareholders' wealth, and that is the starting point of how the separation must be identified. So we should also identify to say, why are the directors also the shareholders, and in some instances we should make meaningful why the directors are also not the shareholders of the business, and how that affects the reporting process. All right. So that is very, very important. So there are two responsibilities. There is a strategic responsibility and there is a fiduciary responsibilities. All right. Even though the directors prepare the financial statements, they also use the financial statements to evaluate the performance against targets. Hence, we at small business practitioner, we say, let us start whatever we do with the budget. You will see that in 1.5, we start with the budget. In CPD 1.5, we start with the budget. So whatever we do, we start with the budget, so that whatever we incur, we compare it with the budget, so that we evaluate the direction in which the company is going. So whatever information we get from the budget and the actuals, that information might help us to be relieved, or might want us to do further work that will identify how we're gonna improve the situation going forward. And depending on how things have went, we might also want to see where to allocate resources effectively for us to maximize the shareholders' wealth. Then we might also want to use financial statements to understand how do we plan for the future growth. And also, from whatever that we have seen from all of the other users of financial statements, we can use financial statements to manage and report risk exposure. That part of the financial statements, we call it a strategic decision making process of the use of of the financial statements. Then on the second side, we've got the fiduciary responsibility, which is talking about the legal implications of being a director and the role of producing financial statements. So in that phase of the financial statements, the most important part there is that we want to ensure that the financial statements are accurate. However, the financial statements cannot be accurate if the bookkeeping is not accurate. And we want to ensure that the directors understand that they maintain proper accounting records for their businesses. Okay, there are rules and regulations for maintaining that. The Companies Act is very clear in doing that. And also, directors must always act in the best interest of the company. They must always prioritize the company, and they must always make sure that they prevent fraud from happening in the company itself, and comply with the regulation requirements. So in small business environment, we've seen that directors often serve multiple roles as shareholders sometimes, and managers, and also shareholders and directors, and sometimes shareholders alone. And from this particular moment, I'm sure there's no doubt in your mind with the level of responsibility and the level of understanding that directors should have in running their business. So once you take a position of being a director, now you understand what is on your shoulders and what must be done. In conclusion, I think we must make it understandable that as a director of the company, it is very important that as you are about to produce the financial statements, you must recognize that there are different stakeholders in your business, and a different stakeholder approach must be taken, and we must understand the unique concerns and priorities of each stakeholder in the business. So the production of financial statements does not start when you want financial statements. The production of financial statements starts at the time you get into business. When you open the year, the production of financial statements has been started. The bookkeeping that you've done on a monthly basis prepares you to produce a solid set of financial statements. You must be consistent with what you are doing and try to present consistent financial information to all stakeholders rather than tailoring reports for different audiences. We've already mentioned that in some instances, small businesses, especially those are involved in construction, when they want to submit to CITB, they want us to produce a different set of financial statements. When they want to submit to SARS, when the tax season comes, they want us to redress those financial statements. When they want a loan from the bank, they want to use the financial statements that they use at CITB to go to the bank and so forth. When Department of Labor comes, they want the financial statements they send to SARS for us to give them to the financial statements. Perhaps we need to clarify this. Uh, I talked with one of the accountants was unfortunately got into this problem, and I said to him, even though this is wrong, each time the client is asking you to change financial statements, just remember that you are doing a new set of financial statements, and you must charge that set of financial statements, which was another combating procedure, so that you alert that there are cost implications in doing this. And whilst small businesses are going forward, they must embrace transparency, try to be honest with their reporting processes, try to be open with how they do things so that their financial statements build trust with all stakeholders and strengthen business relationships at all times. And don't be afraid to ask for professional guidance. I mean, the small business practitioners is there now to help and to make sure that things are happening in the right way and we're taking a right direction in doing things. So the aim there with small business practitioners is to make sure that you are working with qualified small business practitioners who are really eager to make sure that there is accuracy in what we do and there is compliant financial reporting. Remember, there is no way we can have compliant financial reporting if we don't take care of our books. I must correct this. Bookkeeping is not about debit or credit, debit sales or debit. No, that's not that. Bookkeeping is what makes up a sale. Then once you understand the process of making up a sale and you have taken care of all the things regarding the sales, then bookkeeping is finished. Whether sales are debited or credited, that is the responsibility of the accountant. But what we know is that all the information pertaining to how much we have made, uh, where are the documents of what we have made, the sales return, is that correctly packaged, and all those things, that is bookkeeping. Is there a file that talks about our sales in the business? Once we're able to produce that file and say, here is the file that supports the sales that are in the financial statements, bookkeeping is done. Financial statements are the universal language, we must state that, of the business, and it is important that all businesses understand this universal language. Universal in the sense that small businesses encourage a practice where the small business practitioner, a chartered accountant, and the FRC understand exactly what must be done, how it must be done, where it must be done, and who must do it. So with that process, with that defined product process, we are hopeful that things will go a little bit easier, a little bit faster, with some form of understanding. By understanding how different stakeholders interpret this language, we understand that small businesses can communicate more effectively going forward. And with that, we are hopeful that they might build stronger relationship with all users of financial statements. Now, what is important in this volume is that you have to identify yourself in each part of the equation. Now, it is possible that you own the business, you are the director of the business. In one instance, you will be the supplier because there are customers who are buying from you. In one instance, you might not be an employee, but you have employees that are sitting under your wing. You have a responsibility to government, and what is that responsibility? And if government has got that responsibility to you, what is that responsibility? And also customers, what is the role of customers to your business, and what type of information do they want from you? So that must be clear in your mind. You must not say you don't know. Competitors, there are people who are competing with you, and for that fact, it means that you are competing with other people as well. So you need to get that straight in your mind to say what type of information you need and how you must disclose that information. You are not operating in isolation. You are operating as part of the community. Your business has got an address that belongs to a certain community. So what is your responsibility towards that community? And you and as directors of the business, what posture are you taking in making things right in your business? So don't say now you don't know financial information. You are not an accountant or what. Now we are presenting with you to you an opportunity to understand what the accountant will be reporting, what the accountant will need, and you are part of that. So as we conclude, we want to mention to you that in the next chapter, we will be dealing with chapter one, that is the chapter one, and chapter two in our next presentation, which is the lenders, which is the shareholders of the business and the lenders of the business. Then we'll continue to update you what needs to follow. So that is how we're gonna deal with volume 7. Ladies and gentlemen, I'm hopeful that I have been able to introduce this important volume, and to address identities, who exactly we are dealing with here, and how the users of financial statements should know one another, and what information the other user wants from the other user, and how much information the other user wants to know about the other user, and when is that information is important for it to be accessed. Thank you so much. I will see you now in the next part. Thank you.